Cryptocurrency is creating financial freedom for a lot of people. And the blockchain technology that it's being built on, I believe is going to disrupt traditional industries and innovate the way we use the internet. Oh, wait, it already is. The question now for a lot of new people is, should I invest in Bitcoin? Should I invest in Ethereum? Should I invest in other altcoin cryptocurrencies? I've been thinking about this question for the last few weeks because I want to be thoughtful and careful with what I say. The more that I thought about all the specific investment strategies, all the different projects, the way that I've been learning about fundamental analysis, trading, all my adventures in cryptocurrencies currently, and trying to compile and pull all of these different things together to give great advice and information. And also knowing that I'm not a financial advisor, what I'm saying right now is just my opinion and should be used for educational purposes only. And knowing that, the more I realized it would be completely irresponsible of me to give any information without this. And what this is all the personal finances that would need to be handled before thinking of even investing in Bitcoin, Ethereum, or any of the other cryptocurrencies. So here's the 18 personal finance areas to have handled before you invest inside cryptocurrency. 1, know where all your money is going, how much you owe, and what you spend your money on. The easiest way to do this is to start tracking your expenses. You can do this through a tracker and do it manually. You can write it in a notebook. You can open up an Excel or spreadsheet software, or make it really easy and then connect all your financial accounts to Mint. Mint is an app that I use that tracks all of my software, but I also use my checking software that has a spending report, and that lets me know what I'm spending my money on every month. And then so I can see if I'm on budget, if I'm not on budget, and where my excess money can go. 2, you want to pay off any credit card debt or any high interest loans. Investing in cryptocurrency, it's not a guarantee, and you don't want to risk anything that you can't lose. If you have any credit card debt, it's going to accumulate interest. And just like how compound interest and saving, building upon your interest and your capital, it goes the other way. If your credit card gets out of hand, and you'll be paying a lot more in interest over a longer period of time. So your money is better spent typically in paying off your credit card debt and high interest loans. 3, be creative and cut expenses on the things you don't care about. So I'm not saying don't spend it on the things that you love. Maybe you like eating out with friends. Maybe you like going out to the bar pre-COVID and getting around for your friends. So continue to spend your money on it as long as you're still saving for your long-term finances and your investments are growing. But for everything else, be creative and find ways to save money on your expenses. One of the ways that I do that personally is I don't drive a nice car. I have a 6-figure income. I drive a car that is paid off and is worth $8,000. 2006 Mazda 6. The roof is falling apart, but I don't care about cars. I just care about getting from point A to point B and having my car paid off. 4, have a cash emergency fund. This is gonna be anywhere from 3 to 6 months or 6 months to a year. What this depends on is how long would you be out of a job? Worst case scenario, trying to find another job and replacing your income. Could you create another income? Do you have other skill sets? Could you get and replace and cover all your finances right away? But if you're in a higher risk industry, it's harder to move positions. Your salary is harder to replicate. Then you're gonna have to have a higher cash emergency fund. 5, create and align your financial goals with your personal life goals. Because if you're just saving money to save money, the motivation for you to keep going and the drive when things get hard, it's gonna be hard to keep that up if you're just saving money and it's not really going to anything. But then when you have goals that you're setting it for, you have major life things, a lifestyle, all the different things that you want to achieve, adventures, your bucket list, experiences, friends and family, a house, whatever you want to save for, tie that into the lifestyle and your overall life goals. It makes it easier to be driven and motivated with you when you have that specific goal in mind and you're excited to work more, to save, and to be able to continue forward when things get tough. 6, pay yourself first. You can do this by automating your finances so it goes directly into your investments and to your savings goals and what you need to save for. And then after, you can allocate it all to your expenses and then fun things that you want to buy. What tends to happen is we'll spend more because we have more inside our funds, but if we pay ourselves first and allocate that to all the places where we want it to grow, from our investment to doing everything else that we need ahead of time and putting into our savings and our savings goals, it'll be easier for us to budget off of the remainder and to be able to pay off the bills that are needed and everything else. 7, surround yourself with financially literate people. Your social circle has a big effect on you and who you surround yourself and who you're influenced by. Not only the people that you're directly in contact with, but also the people that you're taking content from, who you're being influenced by. Your network is your net worth. So if you spend the most time with people who are financially literate and they're happy, you in turn will be happier and it'll be easier to stick to a budget, to savings goal. It'll be easy to leverage all of the different knowledge that you all have, from different investments, how you're making additional income to how you're saving. And this way you have a support group and it makes it easier because your environment makes it harder for you to fail because you're around people who already are financially literate. And on the flip side, if you're with people who are not financially literate, it is harder to save. You get questioned by all your decisions. You are judged. It feels like you're always explaining yourself and you're burdened by everything and you feel like you have no support. It's harder to meet your financial goals. So you want to have friends that support you and friends that can teach you things and help push you and keep you accountable. 8, build up your credit score. I started out with a really bad credit score out of college. It came down to a 468 because of a lot of bad financial decisions and not taking my personal finance into my own hands. I have a video up here, just check it out, and it'll explain it a lot more here. But long story short, you want to be able to handle your credit score because that is an indicator of a lot of big savings that you can have in the long run, from your mortgage to your house, to the car loans that you get, to everything else in between. You're going to be paying lower interest over the long run. You're going to want to improve your credit score. You want to aim for the bigger wins. That will save you a lot of money in the long run. 9, you want to start putting your money into a retirement account. There's a staggering amount of Americans that do not put money into any retirement account, which is crazy, especially when you consider all the different options that you have, and it's free money if you have an employer match. Match at least up to what your employer matches you to. That's free money you're leaving on the table, and on top of that, it'll create compound interest that I'll talk about later. 10, self-aware spending. You're just gonna be aware of the spending and have a certain percent go into your major categories, and that you're gonna try to keep to this every month. 50% is gonna be going to your bills and necessary expenses. 10% is gonna be going to investments. Another 10% is gonna be going into savings. And then a 30% is gonna go into a freedom fund that you do whatever you want with. Ramit Sethi calls this a guilt-free spending fund. So this is average. Sometimes you hear it called a 50-20-30 fund, where it's 50% on expenses, 20% on investment and savings, and then 30% on entertainment and fun. Personally, right now, I want to save more, and you want it to match within the lifestyle that you have. So currently my spending allocation is 20% expenses because I brought it down a lot, 35% investments, 36% savings, 6% freedom, guilt-free. You can change the allocation however you want. I'm just building up a lot more to be able to take advantage and build up financial freedom later. Earlier, when I was younger, I partied more, I went out with friends more, but now as I'm getting older, I want to have my money work for me, so I'm prioritizing investing significantly more, especially within crypto, because of the opportunity that I see within the market and for the future. 11. I don't know if this is 11, but 11. If you don't make a lot of money, some of this is going to sound out of reach. So now the goal should be to prioritize is to be able to make more money. You have a cap on how much you can start saving and how much expenses you can cut, but you don't have a cap on how much money you can make. It's going to be now about how can I be more valuable to the company that I currently work for, and how can I get a raise and get my boss invested in my future and getting me on a path to make more money. And it's also what kind of secondary income, side income, second job, freelancing, business on the side. What else can I create or build to be able to give me additional income, to be able to just make a little bit more? Start brainstorming, try to get ideas, and then start trying out new things, and then get yourself on track and focus on this part. 12, figure out your comfort level with risk and your appetite for risk and your risk tolerance. This is going to be important for any investments that you make moving forward. Think about how much you're willing to risk where you can still sleep at night. How much do you feel comfortable with risking and also potentially losing either a percentage, especially because investments have a risk. They're risky. Some investments are more volatile. Cryptocurrency is very volatile. So seeing swings of 20 to 30% is normal. And are you okay with those major risks, and then understanding them more and learning about them more with the assumption that you could lose this? Any type of investment is going to carry a risk. 13, you want to create an investment portfolio based on how much time you want to invest in it. Are you going to be active, or are you going to be passive? Are you going to be smart, lazy, and just let things work for you and invest in index funds and just be very, very hands off? Or are you going to be actively trading and learning and digging into the nitty-gritty nuances and developing this as a skill for the long run? Also, based on your research, based on your belief in the investments, your risk tolerance, you want to create a portfolio allocation based on all of that. But right now, start to think about your portfolio and your different investment options. Read more into the different markets, from the stock market to cryptocurrency, bonds, all of the different assets, index traded funds. You want to be able to start diving into them and learning about them a lot more. And then the ones that you feel good about, the ones that you understand, the ones that you want to invest, the ones that you believe in, those are what you're going to be putting your investments into. Those are the things that you want to create your investment portfolio on, based on all of that and how active you want to be able to manage them. So now we're going to go into 14, is whatever you track, you tend to improve. There's been a few studies done on weight, and just by the fact of weighing yourself and tracking it, you start to lose weight because now you're aware of it. And when you start to do that on a consistent basis, you start to be aware of all the different choices that you make. The same thing with your wealth. Now, the biggest thing that you want to track is going to be your net worth. You want to look at your assets and your liabilities. Your liabilities are things that you owe money on, or you have investments. Those are going to be your assets. And then you're going to have to subtract your assets from your liabilities to get your net worth. Simple equation: lower your liabilities, get rid of the debt that you hold and all the different liabilities that you have, and then increase the different assets that you accumulate, and also the different assets that accumulate interest, to be able to grow your investment and to be able to grow your personal finance and your wealth over the long term. Make your money work for you. 15, use the power of compound interest. Simply put, compound interest works this way. Say I have $1,000 and it's going to grow by 10% by the end of the year. Now I'm going to have $1,000, and then 10% of that is 100, and then now we combine it together, it's 1,100. The next year it's going to grow on top of itself. Instead of just being $1,000, it's going to grow from 1,100, add 10%. But when you add on top of that, plus whatever else you add on that, say you add another $1,000, so now you have 2,100, 2,100, and then it grows by another 10%. And then you add $1,000 the next year, grows by another 10%. And then you keep adding, and the interest just keeps stacking onto each other, and it just becomes bigger and bigger and bigger and bigger and bigger. Next thing you know, your investment is growing on its own more than you could have ever imagined. That's why it's important to start investing early, so that you can take advantage of the compound interest, so it just exponentially starts to grow on top of itself. And another way to put this into perspective is to show a 16-year-old girl or boy investing, and say they save $2,000 into a Roth IRA, a Roth retirement account, and then they stop at the age of 21, 16, 21, 6 years of investing, $2,000 each of those years. Let's just say that every year this investment grows 9.4 every year, which is the average return on the stock market since 1926. From the interest of it compounding till the age of 65, when he or she retires, they're gonna have $1 million. Think about that. They're gonna be a millionaire by the age of 65 for only investing for 6 years, because of how early they started to invest. So the more time that you have, the less money that you have to invest, the more time it has to compound on itself and grow exponentially. The earlier you start, the less money that you have to put in, and then the more that your money can grow through compound interest. 16, hold yourself accountable for your own results and don't blame anybody else. Take control of the responsibility of your finances and your financial future. Take action, take responsibility. It's all your fault. And what I mean by that is that it's not anything outside of your control. Yes, there's gonna be factors that are outside your control, but there's always gonna be something that's within your control. Whether that's how much action you take, how you react to a bad moment, how you pick yourself up. If you're always at the mercy of somebody else, some other reason, and you never take responsibility for your finances or for anything in your life, you're always gonna be at the mercy of some external factor. You're always gonna be out of control. You're always gonna blame somebody else. You're gonna always blame the stock market, the economic situation, crash, the recession, but there's always something within your control. Even when things are hard, there's always something that you can do that's something within your control that you can take responsibility of. It all starts with accepting that it's your fault, and it's empowering that it is your fault and that you can do something about it. So take control back from trying to put an excuse onto it. Yes, there's gonna be times where you're gonna be valid and it's gonna be realistic that it was out of your control. It's easier to blame something else, especially when it is valid. But you can either blame something else, or you can figure out a way to take it back and see what you can do about it, despite what happened, despite how you feel, and despite where you're going right now. Take control back for your finances and where you're heading in life. 17, always invest in yourself. One of the best investments that you can ever make is inside yourself and in your education. And I'm not just talking about schooling, advanced schooling, getting your master's, especially when your field requires it, but your ongoing education and investing in yourself, your personal finance, and all of the different things that you want to learn to further yourself, to make yourself more valuable to the market, to be able to grow personally, financially, emotionally, to become the person that can achieve the goals that you want. Because for where you are right now, you need to be able to gain knowledge and invest in yourself so you can become the person that can achieve your goals. And the best way to do that is to surround yourself with the knowledge and the skills through learning and investing in yourself for the long run, and being intentional about your personal growth based on your financial goals and your personal goals and what you want to achieve in life. To put it into context, I have a training fund that I allocate $100 to every month, so that when there's something I want to buy, from whether it's a book, whether it's an online course, or it's an event, I can take out of that fund and then invest it back into myself. Lastly, 18, a goal without a plan is just a wish. Make sure you set goals with an action plan. If you set goals with no action plan, with no plan whatsoever, they're just dreams. They're just wishes. They're just things that you think of that you don't really hold yourself accountable for and that you don't achieve, especially if they're complex, especially if they're hard. Put an action plan so you can make it tangible, make it practical. It makes it so that you know what you need to do to achieve your goals, or you have a plan to head there, and then you can adjust as you go when you don't reach your goal or if you're slightly off track. That being said, to be able to help with this more, I have a video on goal setting, but not just goal setting, goal achievement. So watch that video next. Like the video if you like the video, subscribe to the channel if you like crypto and personal finance, and just to get more details and education behind this and exploring the financial wild west called cryptocurrency. Cheers. I'll see you in the next video. Take care. Bye.